This is Endgame, and I'm Amanda Cassett. In this episode, I speak with Pranav Kanade, who runs actively managed crypto strategies at VanEck's, an asset manager with $110 billion under management. We unpack how institutions evaluate crypto through a TradFi lens, why Pranav thinks the space still struggles with seriousness, and I challenge him on whether financialization distorts incentives around building and research. We also talk token lockups, long-term founder alignment, and what VanEck looks for in projects. Pranav, you run digital assets at VanEck. Talk to me about how you got into crypto from TradFi.
I should probably clarify. I run a digital asset strategy at VanEck. There are a lot of people that are part of this, and they would probably be upset at me for taking all their credit. But I spent 12 years in TradFi, mostly doing distressed credit investing for a bulk of my career. That included looking at even public equities. And so I generally knew how to look at businesses, understand them, unpack them, value them, and then ultimately deal with complexity, because most of the situations we're looking at are companies that are heading into bankruptcy or might end up in bankruptcy and all that. So I was used to things that are complex. And I spent a bulk of my investing career in a couple of sectors. Some was in energy, some was in technology, media, and telecom. And so I had like a good sort of sector background as well as sort of framework around investing. And then I was visiting Kyle Samani in Austin in 2017. Kyle was my college roommate. We were just hanging out, and this was right during the ICO mania, and he was telling me about how, at the time, I think he owned a bunch of ETH, and then how he was doing with a variety of ICOs, and the whole thing was just brand new to me. So I was kind of fascinated to hear about something that I'd never heard about. And I guess that got me to go down the proverbial rabbit hole and understand what folks were trying to build. Coming from sort of this, structured world of understanding how to, people in academia as well as the traditional investing world tell you, here's how you think about a business and here's how you value it. And then here's how you invest. And then to look at crypto where everything is completely unstructured and like none of the regulatory rules, but also just rules around like what makes a good investment was not written. That was pretty fascinating. So that's what kind of drew me to it in 2017. So I more or less got involved that cycle. Got very lucky. My wife, currently, who was my girlfriend at the time, told me in December of that year that if I didn't stop trading crypto, then she wouldn't go on a vacation with me. So I kind of got out of everything in December, and that ended up being the top. So then I observed sort of that bear market in 18 and 19. Continued to follow things. I was more or less intrigued by what Binance was building at the time, because I remember comparing what they were building to Robinhood and saying, this is kind of interesting, and there's this token. The token seems to do a lot more than just be a traditional equity. It's being used in these kind of novel ways to grow this product, which is ultimately an exchange like anything else. And so I was still intrigued by all of that. And then obviously 2020 DeFi happens, and we're all stuck at home sitting in COVID, and I'm still doing my TradFi job. And I go down again the rabbit hole of yield farming, because it's just like the complexity of, because it started with something simple and then evolved into something very complex very quickly, and that again drew my attention. But more importantly, this time around I was able to say, okay, the products that were kind of promised to the world in 2017, 18 are finally starting to come together, and it's starting to make sense, because I think you could kind of visualize this idea of permissionless markets and composability for the first time as like a user, and then sort of think about how some of these tokens could one day accrue value. So those answers started to come together for me. I guess long story short, I generally looked across the space and I thought there was a certain way to invest in liquids, and I couldn't find anyone else doing it. So I said, here's the strategy that I would do, and I was kind of doing it myself. And then I said, this could be an institutional strategy. And I met Jan VanEck in 2021. I pitched him on it. Took him about a few months to get convinced. And we got going in the bottom of the bear market in 2022.
And the rest is history. I want to return to one thing you said. What makes a good crypto investment? You got into the space because you were curious, because no one had defined that. I'm curious how you've defined it at this point.
So I think this is an evolving theory, but as it stands right now, crypto, I think, is still 90% retail. And so folks like myself are the outlier. So to put some numbers on it, if I strip out Bitcoin and Ethereum and stable coins and just quote unquote look at the altcoin market, it's like a $600 billion market. That's the market cap of all these assets. And give or take, there's $10 billion of liquid institutional capital in the space. So I would kind of bucket myself in there. But there are other fund managers. There are two fund managers that are about 6 of the 10 billion, and then the rest are like the long tail of managers. So again, market cap and AUM are not the right kind of apples to apples comparison, but just they roughly make sense. So point being, most of this market is still largely retail. And given that's the case, the frameworks a lot of institutional people come in with is probably not the right framework, or at least needs some layers of.
What's their incorrect framework? How would you characterize the incorrect framework of the average kind of TradFi or institution coming in?
So if you purely come in with this lens of I'm going to look for cash flows and then look for PE multiples and just copy pasta everything from how you value a stock to then how you value a token, and I'm going to make investment decisions based on that, what you'll probably end up with is a portfolio that massively underperforms the market in Bitcoin, and then investors will just wonder why they give you money. So anyone who I think did that in the last 24 months probably underperformed massively. Those things are a few things to care about. One of the things we've learned is, so I'll take a step back. I think we have a theory that in any given year, when you look at the altcoin world, you'll have like 3 or 5 tokens that will go from nobody really knows about this to a top 20 token or a top 30 token. And when a token does that, when it goes from nobody knows about this to a top 30 token, that drives a lot of performance. And so the question is, can we look at the past token success stories and see if there are any patterns? And the simplest one we came up with was great product along with a great team and founder, paired with increasing amounts of attention on the project and a really good community. So those things together ultimately have kind of the recipe of driving a successful project. Now, obviously, if the product itself is getting kind of organic usage and generating fees, and the fees are making its way back to the token, that's a big positive because it creates an inorganic demand for the token. But that alone is not the recipe. These other things probably matter a lot more.
Backing up, okay, so they're approaching it wrong. They're valuing it the way they value a stock. And so when you look for one of these kind of breakout success projects, you've talked about some of the criteria. What are the tokenomics? Like, how is a good token designed at this point that you look for?
I think it's a moving target. I think the definition of a good token hasn't necessarily been found yet. And I think it's easier for these L1 tokens, largely because they are the base asset in their ecosystem, right? So if someone wants to speculate on meme coins, the place they do it is on Solana, and they have to have a bunch of Sol. Sol is the base asset against all these meme coin pairs. And so you don't have to think about tokenomics as much because there's a population that's coming in there for the utility element. And that utility element creates, let's just say, as people say, REV these days, like real economic value, which the boomers will look at and say, oh, this is really attractive because Solana is doing $3 million a day of fees. If I annualize that, that's like, $1 billion or something approximately, give or take. And Solana is $80 billion asset. So the boomer money, the investment money looks at the REV component and thinks that's interesting, but then there's also this utility element where it's the base asset and it's being used. The L1 tokens fall into this natural category of like, it's well designed, but maybe got there through history and some luck. Like whoever designed ETH should probably get the credit for some of that. Application tokens have not found their right product market fit from a token design perspective. I can't point you to a great app token that's done really, really well in the market in the last 36 months. Now, I think we're going to get there. One of the ways we might... So you've seen a lot of app layer projects or even infrastructure projects turn on their quote-unquote fee switches and accrue value to the treasuries. You're starting to see that, right? And you're seeing... Now the big question is like, well, what are they going to do with that cash in the treasury? And the natural answer is, well, if the regulators permit, they should be doing buyback and burns or things like that. One of the things we saw in TradFi markets generally is like when you have a token that has no external demand, i.e. not a lot of capital from the outside coming in to buy it, you have to rely on that internal capital to buy the token. And it has to be something like within 3 to 4 years, there's not going to be any tokens left as a structure for the token to go up in price. So like the analogy I give is, I don't know if you know this guy, David Einhorn in TradFi. Like he runs a firm called Greenlight. He's a great investor. There was a phase where his strategy was not working because he was a value investor and all that was working in the public equity markets were these growth stocks. But he kind of stuck to what he was doing, which was picking these value companies that no one else wanted. And he had a couple of years in the past 5 years where he crushed it. And I think part of the reason was the companies he was buying, those businesses were generating so much cash that if they didn't go up in price, they would buy back their whole market cap in a few years. So that was like, so it has to be that few year window. Right now, the problem is most of the projects you look at that are kind of accruing fees to their treasury that could do a buyback. If you do the math of like how big is your market cap and how much could you buy back in tokens today, it's still very small. It's like you can maybe buy 15 years worth of, like you need 15 years to buy back your market cap. So that delta might need to shrink, I guess.
Yeah, I have kind of a complicated question about this, which is, so you're talking about the buyback and burn mechanism, and that mirrors something that happens in the stock market, right? Like stock buybacks, and those have been a really huge part of the strategy for companies as big as Apple. What I think about, and this is going to be kind of a longer question, there's this thing called Goodhart's law, where a measure of something becomes a target. And it used to be that a stock price, or maybe, I mean, tokens haven't been around that long, but at least a stock price would be a measure of how well the company was doing. And over time, that price has become a target. And so a lot of business decisions end up getting optimized around making that price high, almost as if Apple considers its product not MacBooks, not iPhones, but the Apple stock. Almost
Yeah.
as if an L1 token considers its product not the actual layer one infrastructure, but the L1 token. And that optimization does lead to different decision making. And so when you have a treasury full of capital, whether you're Apple or whether you're an L1, you could decide to invest it in a way that could lead to more usage of your infrastructure, if you can think of a way to invest it that way. Or you could distribute it out in order to bump up your stock price by making distributions or some kind of distribution equivalent. I guess my
Yeah.
question is, do you think that these projects have gotten good-hearted out and that the financialization has harmed decision making when it comes to building good technology?
There's a lot there. We can go down many different rabbit holes. But I'll touch on one thing. I tend to agree with what you said, which is a company or even a token project should only buy back its underlying asset. In the case of companies, that's equity, and it's in the case of tokens, project's token, if it believes that the ROI of all the things they could invest in, let's just say from an R&D perspective, is worse than the ROI of buying back their own asset, right? And that could be true for two things. One, they
But
might,
I just want
yeah.
to, I don't want to interrupt you, but isn't it alarming if an L1 or if Apple, frankly, isn't it alarming if they can't figure out how to allocate that capital in a way that improves the technology they're building?
It is, but there's a different element to it, which is there might be a situation where the market believes this business or project, whatever, does not know how to be a good capital allocator, such that it prices that asset so cheap relative to intrinsic value that the team has to prove to the market that I am a good capital allocator by buying back the underlying asset, because that, like, the ROI of buying back that underlying asset is greater than whatever R&D they can do. So there might be this like prove it to me that you're a good capital allocator element to it that the market might be telling them. Does that make sense?
Interesting. Yeah, it does. I guess I just wonder whether the focus on the token price or the focus on the stock price leads a company or leads an L1 to concentrate less on building great technology and more on building a great chart, and whether that ends up detrimental to the product.
I mean, it could, right? I guess it goes to the question of let's pick our favorite asset, ETH. Does it matter if the price of ETH does not go up in price in the next decade? Maybe it goes down in price. Would that affect the product, the Ethereum blockchain at all, and the user experience of that blockchain?
I think there are a lot of different opinions on that. I think that a lot of bag holders would be upset if that happened and might abandon the ecosystem and go do their business somewhere else. And I think
Yeah.
now Ethereum has like enough bag holders that or builders that are mercenary in that way, that even if great things were being built on the technology side, if there wasn't new capital coming in, or they're just building businesses, right? They're building
Yeah.
businesses. There's not new capital coming in. It's super logical. They don't want to build in this ecosystem, even though the technology's been improving, the fundamentals are getting better. So yeah, I
Yeah.
think it would be a problem for Ethereum if it kept on improving its technology, but somehow the market could never recognize that and the price stayed where it is. Yeah.
Yeah, I think the other way I think about this is I look at all these L1s as essentially petri dishes where like some cool stuff can happen if there's enough like, I don't know, bacteria there. And I generally think of founders in these ecosystems as sort of like people trying to do cool things, most of them at least. And they generally look at these vanity metrics to decide where they want to build, among many things. So I remember a period of time when I would talk to teams and say, why are you building here? Why are you building on Ethereum? Why aren't you building on Solana? And the answer used to be, well, all the TVL is on Ethereum and all the users are on Ethereum. So even though for what I'm building on Solana might make more sense, it's just that, bigger asset, more TVL, all these things. And that seems to be shifting a little bit now where I hear founders say, I'm going to build on Solana because it's easier for me to show traction and product market fit there because, I don't know, the speculative energy is greater there than, let's just say, an L2 somewhere. But all of it kind of is like a byproduct of L1 token price in some shape or form. So in an idealist kind of way, yes, like teams, L1 teams should really be optimizing for building great tech and sort of be focused less on the token. But reality is like the whole thing has path dependency, and one of the biggest drivers of that path dependency is the token price.
I want to shift slightly to what do you think the right way is to do a TGE in 2025 for people that are deciding where to build, for people that are bringing new tokens to the market? What should they be thinking about?
So I guess I should disclaim it as not financial advice, not legal advice, any of that, right? It's just in a hypothetical world, if like the regulatory environment were to permit any of these things, then this would sort of make sense. That's how I would frame it. So I think it's really important to, I tell people like we all came here kind of for trustless tech, but what lacks in crypto is trust. So I think the number one goal for every founder and team should be to over disclose and be as hyper transparent as you possibly can to build trust. Because what you want is the holder base of your token to look at your project as like, I believe in this founder and this product and I can own this token and sleep well at night, and then kind of be reminded every day why I own this thing, because there's always someone else trying to like get you to like sell the thing you have and buy the next thing. So those things are super important. So I think if you can, as a team and founder, kind of build trust through transparency where the end user base can own this asset and just say I can sleep at night, that's like a good starting point. The next place would be to say something along the lines of trust. I think too many people in crypto have promised to build great things and then they make a little bit of money and then they stop building their great thing and they just are like, in Portugal doing whatever. Somehow aligning their outcomes, their financial outcomes to the success of what they're trying to build is super important. And that we've, debated many different ways to do this, like KPI-based vesting or something other than time-based vesting, where like the time-based vesting thing, I think incentivizes teams and investors to basically promise a dream as long as they possibly can until their tokens are vested, so then they can monetize that token. It just creates bad behavior. So I think you want to balance some time element along with a success element, so that again the purchaser of the token or whoever's buying the tokens can know that they can sleep at night knowing that the founder's doing what he promised or she promised that they were going to do day one. And then the last piece would be to try and have a large float so that you can have good price discovery. The dynamic we've had for the last year, and it's just changing, this really started changing in Q4, was, you had these situations, again, it's through a confluence of incentives where and regulatory stuff, but like really, you'd have these tiny floats, you'd have these founders and teams that would go like paint a crazy vision and get everyone jazzed up, right? Because like you need to have a big FDV so that when you vest, you can then start to sell it. But the tiny float plus big vision led to these inflated, fully diluted values, and ultimately a price that went down only especially once the vesting began. So I think if you were to have a large float, then you would essentially have earlier price discovery. As in, like, the market would reach a fair price that reflects the risk profile of the project, and that would likely mean a much smaller price or like lower price, which obviously is not great for the VCs, because all the VCs really want to mark up their holdings and then send these nice investor statements that says, look, I made you 10x, even though it's not like really a 10x, but so that changes some of that too.
I think that founder point is really interesting. The least charitable version of what you're describing is an exit scam, right? Where you hype everyone up, you make a bunch of money, you get liquid, and then you get out of there. And that's obviously not great for crypto or for investors. And then there are these other examples in the crypto space and in general of incredibly successful builders choosing to continue to build. You see like the Jeff Bezoses and the Elon Musks. Then in crypto, you see folks like Vitalik, like Hayden, people on the Solana side as well, people that have done exceptionally well, but that have continued building awesome things because they really care. How are you thinking about redesigning lockups? Are there specific structures that you've seen successful for incentivizing great people over time? Or is this more a matter of character?
I've talked to a couple of founders about this, some that have totally embraced the idea. But it's funny, like the founders of some of these projects love it. And then when they communicate it with their team members, they're like, what the hell? Like I thought I was going to have this big liquidity event in the next 2 years, and this investor is now trying to tell me to change it. So people don't love this. But I just started with like taking Elon's 2017 compensation plan from Tesla, and you can literally copy paste that idea for your project, which if you go back and remember, this is the one that the Delaware courts tossed out and in litigation. But essentially, the short version of it is that he had this massive payout that would happen if he met a set of metrics, that basically how many cars they sold and produced, these other financial metrics of how profitable they would be. And I think, and don't quote me on this, but I think the price performance the stock also was one of the metrics. So you kind of pair sort of what makes your business successful along with also let's make sure the stock recognizes it and you're also successful. So you can apply a similar framework here, which is identify KPIs, but then the pushback on that is like, well, people could game those KPIs. So then you also have the price market metric too. So you need to have all these conditions to be met so that you can get paid out. Now you don't have to do the whole, it's not all or nothing, right? You can have some time-based thing and then some KPI-based thing, ideally more on the KPI and price side.
Got it. So one metric that I've been hearing about more is actual revenue. And you mentioned turning on fee switches, but I've been getting the feeling like our space is I've been calling it a flight to reality, where it almost was a bad thing to have revenue for projects at one point because it meant you could back into a valuation through a multiple. And if you don't have revenue, then you can't do that. And maybe the valuation is infinity. Have you also been seeing this kind of flight to reality and emphasis on fundamentals? You mentioned boomer money, like actual revenue. And do you think that this is something projects should focus on right now?
I think they 100% should focus on it, but I don't think they will necessarily be rewarded for it in the near future. But that doesn't mean they shouldn't focus on it, because I think the end game will reward it. And the way I describe the end game is, a common thing we see is because we have an ETF business on one side, and we see a lot of projects come to our ETF side and say, we would love an ETF, and just because like someone creates an ETF for you, that doesn't mean anything because someone's got to sell it. You can I think this whole idea of having these massive amount of single token ETFs is not a good place to be, because the people who are selling it to the end user don't really ultimately know what they're selling when you go down the list, right? They finally figured out how to sell the Bitcoin ETF. Like now they got to figure out how to ETH is a little harder, and then you go down that list and it gets harder and harder and more confusing to like the end purchaser. Because the picture like this wealth management firm, that's got a bunch of doctors and lawyers as clients, and they were just sold some Bitcoin, they were just now maybe sold some ETH, and now they're like selling the next thing, and like they're like, how many of these do I need in my portfolio, and what does each one of these things do? So it becomes really complicated very fast. And so what I think is the end state of all this are multi-token ETFs, where you'll have a basket that is rules-based. And you can look to public equity markets for those things, right? So the S&P 500 has its own set of rules, which gets you included. I think the most successful multi-token ETF products coming out of crypto will be rules that center around usefulness and revenue. And ultimately, that's going to be the product that will get sold to the traditional channels, where the pitch is going to be, do you want blockchain exposure, here's a product you can consider, rather than each individual token. So if I back into all that, what I would say is getting included in one of those products one day is going to be super important. And I think if you believe what I'm saying here, which is a revenue-based weighting methodology makes sense, then a project should focus on that because that's the end game. But I could be wrong. Maybe we make a bunch of different baskets and one of the baskets is like a meme coin basket and then that gains the most popularity. Who knows? The world's pretty interesting.
What are you the most excited to see built?
Tokenized equities. So I came to the space for tokenized equities, and I think it could be very simple, but also you can kind of think about a few different things. So when I originally thought about why tokenized equities, I thought the simplest answer is you could do a lot more for your business if your equity was on chain than sitting at the DTCC and it was then stuck in some brokerage app, right? So I wrote a blog about this on what Tesla could do if Tesla was tokenized, and the simple argument I made was anyone that used FSD in those cars should be rewarded some Tesla stock for doing that and helping with data collection and those types of things. Help Elon get to 5 million miles faster than he normally could without it.
And why would they want to do that? Maybe you can explain why it would be in Tesla's interest to reward their car users with stocks.
Tesla wants to get to Robotaxis, and you need to have a certain amount of miles per intervention is kind of the metric they track, which is how frequently does the driver intervene when the full self-driving is turned on. At a certain threshold, I think it's 10,000 miles per intervention, the thing is ready for robotaxis. And that's a huge enterprise value unlock for Tesla once they get there. But in order to get there, what they need is enough existing Tesla drivers to turn on FSD and intervene when they feel like it, because the system learns a lot better when that happens. So if you can increase the number of people buying FSD, using FSD, and then intervening when they need to intervene, that's valuable data for Tesla. Now, I just think in general, and this is just anecdotal, a lot of people own Teslas, but the FSD attach rate is low, and the people that even have FSD, they don't turn it on as much. So you need an incentive mechanism to get these people to do this. And rewarding them with ownership of the business that would benefit from them doing it is an easy way to close that feedback loop.
And so when you imagine tokenized equities, do you imagine them trading like crypto permissionlessly? Is that the end state that you want to see?
I guess I would define permissionlessly. Is it realistic for me to think I will be trading tokenized, again, XYZ stock in the same pool that a North Korean could go trade? I don't think that's realistic. So I think there'll have to be some level of permissioning. The question is how much?
But it could be an on-chain permissioning measure like some of these privacy pools. It wouldn't necessarily be legacy system KYC.
Yeah, it doesn't have to be that, right? I think I remember last year, one of the things people are exploring is once you onboard to a centralized exchange, you're KYCing there anyway. Could they send you an NFT or, what do you call it? I think it was called a soulbound NFT or something to your wallet that says that you've been KYC'd, and now you can interact with a whole bunch of things. You don't have to KYC at every single place.
But you see the centralized exchanges as necessarily having a role in this. I've been thinking a lot about, what it means to be doing things on chain, what it means to be kind of staying in the DeFi world as opposed to the CeFi or TradFi world. And maybe this sounds silly, but it's almost like a UX. It's almost can I keep my assets on a ledger? Can I move my assets between my MetaMask or my Rabby and my Phantom? Can I stay in that world of those kinds of self-sovereign wallets without interacting with something permissioned like a centralized exchange or like a traditional custodian or anything like that? I think that world will just increasingly feel like a UX almost, and people will want to stay in that UX and will avoid interacting with, or some group of people, right? Well, and avoid interacting with the kind of more legacy, create an account, log in, add your passport kind of tools, and will want to just stay in this sort of permissionless loop. Do you think that people are going to be able to trade equities in that kind of permissionless, self-sovereign world?
Do you think people want to? When I say people, I mean 5 billion people have an internet connection. I think 2 or 3 billion of them have an Instagram and Facebook account. That population, do you think they want to be doing this? Because
Yeah.
I'm not convinced most people want to do self custody.
I look at people with really small amounts of value in crypto, and they're not custodying it themselves. They're custodying it on some small local centralized exchange on their mobile phone. In emerging markets, that's the trend. My question is really about what the future of crypto is going to look and feel like, whether it's mostly going to be people interacting with assets in this decentralized sovereign context, which is whence crypto came from, or
Yeah.
whether you imagine it as really turning into TradFi and mostly being interacted with through these kind of TradFi platforms.
So I'm going to answer your question, but answer it differently. I think crypto has many properties that make it interesting and unique, and like programmability of these assets is one. Being able to self custody and engage in permissionless markets is probably one. There's many things you can kind of go down that list and say, here are all the properties that make this technology interesting. And we all, as an industry, thought there are certain things that made it more interesting to us than others. But it might just be that the market finds some of the less sexy things more interesting. So being able to program these assets might be the thing that actually finds product market fit, and not this other stuff. The other one I was actually, I don't want to like digress too much, but like the other thing I was thinking about recently was, and actually came from looking at what Pump.Fund did with PumpSwap. But TLDR there was PumpSwap allows you to take a percentage of the LP fees and give it back to the creator. And I was like, well, that could be interesting for tokenized equities, because right now, like, these stocks on the equity market trade insane amounts of volume, but the revenue from the trading volume does not go to the company itself, doesn't go to the issuer. It obviously goes to the market
Right.
makers. Right? So imagine, I can give you like a massive list of companies, I'm sure you can as well, that are in like the hard sciences or biotech, or that are trying to do like these big things, but are not going to be profitable anytime soon. They're going to be just burning cash and trying to raise money all the time. But if they were tokenized equities and they could take some of their trading fees, that could augment the cash burn. And that's like a pretty massive unlock for a lot of businesses. Like, you can pursue like a big idea if you can convince retail or just a population of people who are not sort of sitting at these gatekeepers to be interested in what you're building. And that thing's going to have a lot of trading activity and velocity, and going to generate some trading revenues that these things can benefit from. There's other interesting things outside of like the whole element of like the self-sovereignty thing that the market might just end up with and saying, this is what we like from this industry, and we're going to like build around these concepts.
Yeah, I totally get it. And I think that is a good return to kind of the TradFi roots here, right? Like, crypto came into the market with this set of 10 different value props, right? Like self-sovereign, permissionless, decentralized. And then it also had these other value propositions like programmable, composable. Maybe some of those will get selected for and some of them will get selected against. And as the space becomes more institutional, I guess the opinion makes a lot of sense that it could be that these more like cypherpunk things get selected against by these institutions, and some of the things that don't have those kind of properties that really get selected for in the end. So maybe you can describe what's the end state if crypto does the thing that you think it's going to do to the fullest, if it realizes its full potential in terms of product market fit and adoption. What does that world look like?
To be honest, I don't know, because I can speculate, but these like the crypto markets continue to surprise me in many different ways. So, but to me, an ideal end state is all these public equities that exist on the TradFi markets end up on chain, and those issuers are able to leverage this on-chain asset to improve the unit economics of their business. Like, that would be interesting. And then the future list of companies that are to go public in the future, like, I don't know, SpaceX and Stripe and all these things, they choose to IPO on chain in token form, in like sort of a pure equity form. And they can be called tokenized equities, whatever you call them. But I would love to see like sort of that line blurred between token and equities. The public equity markets have a time horizon of like 3 months or 6 months, like something really short. And while crypto seems to have a very short time horizon, judging by the market caps of most of these projects, you could make an argument they actually have a very long time horizon. They're willing to hold on to assets at inflated prices for a very long period of time. So I think crypto is actually a great capital market to fund moonshot ideas the public equity markets once used to fund. So bringing that over and then trying for crazy ideas while giving people exposure to it, or having liquid exposure to it, is going to be interesting.
Cool. I like that. VanEck has said that we're going to keep having a bull market through 2025 and get to 180K Bitcoin and 6K ETH. What makes you guys say that? And what kind of stock should people put in predictions? Because I've seen a prediction of just about everything.
So I should clarify there. I don't make predictions. Like, we have a separate research team that publishes research and
Predictions
then makes these
department,
predictions.
the Department of Predictions. You're
Right.
in the Department of Reality, and they're in the Department of Predictions.
I'm just in the I'm just in this world where there's so many moving parts, and it's very hard to make. I think it's almost easier to make a prediction for 3 or 5 years out than making a prediction for like what's going to happen in the next 9 months, because like there's so many factors that drive that. So I'll kind of have to say that's something you might want to ask like those guys, because I don't get involved with the prediction part of it. At this point, most people doing these predictions for year end are doing it largely for entertainment purposes, or just kind of like, you're like hanging out with your friend at like a bar and you're talking about who's going to win like the NCAA championships. It's like the same kind of conversational thing you do with predicting the price of Bitcoin for year end.
So separate from your kind of purview, that makes sense. Some non-financial prediction. Do you think that in the near future, most financial transactions will be undertaken by AI agents? And are they going to use crypto?
I go back and forth on that. I do think a lot of transactions will be done by AI agents. Like, I'm personally an investor in Perplexity, and I love to listen to Arvind Srinivasan talk about what he's building. But also, I use the product a lot, and I think you could see a scenario where there are agents within their product profile that just completes tasks for you, like, knows your history of travel and does book all your booking, and it's a bunch of different agents interacting to sort of compete to do that job the best. So I can see that happening. I just don't know if those agents will use crypto rails, i.e. stable coins, or will they just use traditional banking rails? Like, if these are just closed systems or platforms, then it's less clear to me why they would use stable coins, I guess. Like, if the winner is like a closed system, what do you think? You're probably closer to this stuff than I am.
I don't know. I've been curious to watch attempts to find that kind of holy grail use case. That's the AI crypto crossover. AIs will use crypto if people ask them to. If people want to do things with crypto, then they will instruct the AIs acting on their behalf to use crypto. Faster settlement is important. If logging into accounts and being permissionless is important. I guess it depends how the whole AI agent regime really gets started and how that looks and feels, and what's just the most frictionless there in terms of whether people will choose to have them use crypto or not. It's not obvious to me that it'll be one way or the other. I want to see that UX and then I'll have a good opinion. I've been interested in like the other early gestures at crypto AI crossover, like the AI agent meme coins were interesting. I think there's probably a richer AI use case in crypto than a self-shilling token. And I've been and so I've been watching out for that to emerge. What are you seeing? Is there a direction emerging there for that could get product market fit in that category?
So I was just thinking about this earlier today. As you've probably been on X and you've seen all these people posting photos that have been in cartoon form, whatever they're doing with.
It's the Studio Ghibli. It's the Japanese anime studio that made Spirited Away.
Okay.
It's just such a beautiful movie, and they have such a specific drawing style that whoever came up with this meme was really clever, because they used Studio Ghibli to show how refined and high quality ChatGPT's new image generator is, because it can really make an image of anything in Studio Ghibli style.
So I was playing around with it, I guess, with different prompts. Like, I took a photo of my wedding and I asked it to do it in like Disney, like Cinderella style or something, and it did a great job. So I was just playing around with stuff. And then at the same time, I was just in again, this is just in 4.0, I was doing other queries. Obviously the simpler ones would respond to me in 30 seconds. These images would take like, I don't know, a couple of minutes to render or whatever. And I was just like, these inference requests are very dynamic in cost to OpenAI. I got to imagine, like, some are cheaper, some are more expensive. Yet I'm a subscriber and I'm paying a very fixed cost to them. I wonder if it makes sense to have like dynamic markets for inference in any way. And I could see crypto playing a pretty interesting role there.
Yeah, I think like in general, those are the ideas that crypto would get involved in the AI infrastructure, like decentralized physical infrastructure, like easy ways to pay dynamically. I think that stuff makes more sense than a consumer-facing use case immediately jumping out at me as like the big product market fit one. I don't know if you agree with
Yeah.
that.
No, I agree with that. The weirdest use cases might get traction in crypto first, like the whole AI girlfriend thing might get some
Totally.
traction. Because if you create crypto incentives for people to create really good AI girlfriends that can one day compete with OnlyFans, then you know, I think crypto might be better at that than the non-crypto market because of the
Yeah.
incentives.
That makes sense. Stablecoins. Do you think stablecoins are going to end up the ultimate crypto use case? And when we look back, we're going to see uh, blockchains as a transport layer for the US dollar?
Yeah, no, I think so. It's like the thing that makes most sense to me, and I share the story a lot because I grew up in India, and I go back there every couple of years, and I interact with a lot of like family members and old friends, and I'm always asking like, do you guys own any Bitcoin? And the answer is always like, not really. And then I'm like, well, how do you diversify out of the rupee? And the answer is like, we try to get some dollars. And so I just again using that as an anecdote, and I think you've traveled a lot, I've traveled a lot. Like people just want dollars. I could make the argument that most people outside the United States would really love having some dollars rather than their local currency. So this is such an easy way versus like their current legacy way to get access to dollars that all you need is a smartphone and a wallet. So it seems obvious. But I think once you have that, you can then get those people, like let's just say the market cap of stablecoins get to a trillion and
Hmm.
it's now distributed across a billion people, just making up numbers. But then now you have a billion people with $1 trillion of dollars in their wallets that will be looking for financial products. And now when you go to a startup that is thinking about doing an IPO, you can actually make a compelling case to why they should actually exit on chain in a token form because you have a captive audience that could buy their thing.
Yeah, I wouldn't be surprised if a lot of small cap currencies go away, almost like the way that small languages disappear over time or small species end up going extinct. There's this there, there's this power law thing, right? Like I had this thought. I was in like a taxi in Japan and Taylor Swift came on. The internet has created this Pareto distribution power law thing with art and content where the very top creators are now global, universal, ubiquitous, and the idea
Yep.
of a local artist isn't really real anymore because everything's global, everything's competing globally. The same thing's probably going to be true for currencies. And so right now we
Mm-hmm.
have hundreds of currencies, but why? We could end up with really having 6 currencies.
Yeah, that makes sense. I mean, you see it in the equity markets as well. Like the S&P 500 is now concentrated to basically 8 stocks by a larger percentage than it ever has been. I think in general, people are gravitating towards like, I don't know, maybe this took a moment in time, but like it seems like in all these different industries, things are gravitating towards like, here are the top 5 or 7 best. Like get into those and ignore everything else.
I think the crypto market does that too, right? After a couple of cycles, it calls out all the kind of attempts at a certain outcome, and then there's a new thing that everyone's striving toward. What's something controversial that most people would disagree with that you think about crypto or about tech?
A vast majority of people in crypto are not serious people. I can. Like
Totally.
they just have like no discipline, like or work ethic. I just because I've interacted with so many people at this point, and I come from a world where like people have a goal and they get it done versus like consistently miss goals. I was supposed to do a call with someone this afternoon, and the person didn't even show up to their call. And I've had that happen several times. And it's always like some travel excuse, like, oh, I'm in like this other country, I forgot the time, whatever. And that never used to happen in TradFi for me. So I just generally look at that and say, like, because on the one hand you have Elon that seems to like do amazing things across the board and get all this stuff done. And then there are very simple DeFi projects in crypto that can't ship a simple borrow lend protocol in like, the time frame they're supposed to do this. So I guess it goes back to like quality of people in the space. But I don't know if that's like consensus.
I think that's a great one. It reminds me of that meme from Succession. I love you, but you're not serious people.
I feel that way
Cool.
about this
Well,
industry. But yeah.
I think that's a great note to end on. Thanks so much for spending an hour and having a nice deep chat. Thank you for listening to this episode of Endgame. Please follow me on X, Amanda Cassett, 2 S's, 2 T's. Follow the company I founded, Serotonin HQ, and listen wherever you get your podcasts: YouTube, Spotify, Apple Podcasts, the works.